Today, we're diving into a topic that often gets overlooked but can have a major impact on your long-term success as a real estate investor: portfolio rebalancing. I'm Kathy Fettke, and welcome to the Real Wealth Show.
You're listening to the Real Wealth Show with Kathy Fettke, the real estate investor's resource.
On today's show, I'm bringing on two of our Real Wealth investment counselors, Leah Collich and Stacey Stegenga, to discuss what portfolio rebalancing is. And we'll hear why Leah and Stacey are currently rebalancing their portfolios. If you like today's show and are ready to invest in real estate with Real Wealth, just visit realwealth.com/schedule for a free consultation with one of our investment counselors. And you can choose either Leah, Stacey, or Joe, who's also been on the show several times. All right, well, let's jump in. Welcome, Leah and Stacey.
Hey. Hi, it's great to be here.
Leah, tell our audience a little bit about you.
Yeah, so I am first a real estate investor, been investing in real estate since bought my first one in 2009. Didn't get really serious until 2017. Building a portfolio from long distance, own a portfolio across a couple different states. But I also work for Real Wealth, of course, as an investment counselor. I came to the company in 2019. So I advise our clients on how they can do what I've done and build an out-of-state investment portfolio.
And you've helped so many people. We are so grateful. Stacey, you are new to Real Wealth, but if you would tell our audience who you are.
Yeah, so I was a very burnt out healthcare worker. I worked in critical care as a nurse for 13 years. And in 2020, I bought my first investment property and absolutely fell in love. The power of real estate investing has just changed my life. And I am so excited that I became an investment counselor at Real Wealth in January. So I just love sharing my knowledge and education with all of our community and helping others achieve the same.
And we just get such rave reviews from people who've had the chance to talk to both of you. So again, thank you. So always so fun to have you here because both of you are talking to real estate investors every day, new, highly experienced. You both are very experienced. So you have such a good understanding of what's going on out there in the market. I would say better than what people are reading in the headline news because it's, you're right there in it. So Leah, let's start with you and just what is portfolio rebalancing to you?
Yeah, it's such an important part of being an investor. I think so many people incorrectly assume that, once you get into an investment property, like you hold it forever and that's the way to win the real estate investing game. But what we know to be true is that you have to be willing to revise and improve and pivot as you build and grow a portfolio. So portfolio rebalancing is really this concept of reshaping your holdings so that they're better aligned with your goals and objectives. Those goals and objectives can be fiscal, right? They can be monetary goals, but they can also be a little more intangible, like inner peace. I think it's important as investors to really get in tune to like, what is it that you're wanting to accomplish out of this, and know that you're going to need to put your hands on your portfolio and do some tweaking along the way to keep it on that course for you.
I love that you say that, Leah, because it is buy and hold. So a lot of people think you just buy it and hold it forever, but we do need to be constantly checking in with how our properties are doing, how much equity is in there. Are they really performing the way we think they should? And should we, if not, should we do something else? So Stacey, what would you say are the signs that it's time to make some changes?
Yeah, so there are actually quite a few, but one is to maximize your returns. So the metric that's typically looked at is your return on equity. And I prefer to look at that as kind of the compound benefit of real estate, because if you have 6 figures of equity in one property and is underperforming, and you take that and you then buy 2 to 4 properties, you're compounding the growth and the appreciation of that initial investment and then maximizing those returns. But again, as Leah said, some of the other benefits are more personal. So maybe your portfolio is just extremely demanding. Maybe you have high tenant turnover. You have a lot of risk in your market now. Maybe you have a ton of deferred maintenance that's all catching up at once, and you want a more passive investment. Our new construction properties are a great way to 1031, keep that equity, tax defer it, and then compound it into a more passive investment that doesn't require as much time and attention.
It's funny that we're talking about this, but this is actually how Real Wealth began. Because in the early days, 20 years ago, I was a mortgage broker and I would look at people's portfolios and they had these $1 million properties in the San Francisco Bay Area that were renting for maybe $2,000 a month. And it was so easy to just kind of show them, wow, you could sell this 1031 exchange and we'll get you 10 properties or 20 properties. You're going to 5X, even 10X your cash flow if you do it properly. So I guess really it's the word and the word that's new, but we've been doing this for a long time.
I've watched so many investors through that exact equation, Kathy. People can get this false sense of success, I think, especially with some of their high priced properties, because the cash flow can feel relatively high. Like it can feel like, hey, this property is earning me, $2,000 a month in positive cash flow.
Yeah.
Yeah. And I've had these calls before where they're proud of that. And then I start asking more questions. Well, what do you think the home is worth? And what kind of loan do you have on it? And you help them see actually, $2,000 a month of cash flow on this much equity is really low. You might be earning a 1 or 2% return on equity with some of these homes. And we regularly see new construction deals, like Stacey mentioned, where you can reset all of your CapEx with 4, 5, or 6% return on equity. So that cash flow can give you a false sense of accomplishment, I think, if you're not putting it into the proper context.
So is there a quick way to gauge that? Like, again, let's just say, because this is actually pretty common in the Bay Area where a property may have gone up in value so much that the owner doesn't really know. All they know is their rents have gone up a little and they're happy. But let's say there's it's $1 million property. They have $500,000 equity that's just sitting there and they're making, let's say $3,000 a month. I mean, is there a quick way to just look at it like napkin type math?
I mean, the first thing I would always tell people too, because a lot of people aren't actually looking at bottom line cash flow. They're not factoring in. They might be saying, yeah, my mortgage payment is this, but they're really not looking at, well, what is your insurance premium and what are your taxes and what are some of the maintenance costs that you've had on it? So the first thing would be get really clear on what is your true take home cash flow. And you're basically going to take that for the year. So you're going to say in the last 12 months, what was my take home cash flow in this property? And then you're dividing that by how much equity you have in the deal. And that's telling you for every dollar I have in it, this is how much it's giving me in cash flow each year. And if it's below, I would say if it's below 4%, you should be looking elsewhere and looking to redeploy it somewhere.
Stacey, you are very aggressively shaking your head. Any comments there?
Because Leah's hitting my pain point. Yeah. So I have great performing cash flow properties, 3 of them, but my 4th one is just trying so hard to sink my ship. And when you really look at the maintenance and CapEx costs that I'm spending, it's negating the performance sometimes on my other properties. So I completely agree with Leah. Only looking even at just one property versus your entire portfolio, it just doesn't give you the full picture. So yeah, I really agree with everything she said.
So in your case, you're not talking about one property, you're talking about a whole portfolio. So how would you look at that? In this case, would you still take all the cash flow from all the properties and divide it by the equity in all of them? Or do you go one by one?
So I do go one by one for the specific purpose of identifying. Now, mine is glaringly obvious, but for anybody else that might not have that nightmare property that's trying to sink their ship, I do recommend looking at them one by one so you can analyze which one is the property you should sell. Any property that's not performing should be the first one to go, and then addressing kind of those pain points. If one is more time demanding than the others, then that would be a reason to offset that if you're looking for a more passive investment.
Stacey, there's light at the end of the tunnel. I have to encourage you. Like, this was a theme for me in 2023 because I had a bunch of those really costly properties and also just really properties with really high return on hassle. I mean, low return on hassle.
Yeah.
And so I made it like my intention that year, like, let's get rid of anything that is really low performer and pulling down our averages. And on the other side of that, like, I sleep better. I'm getting fewer emails from property managers. The money's accumulating better. So I go at it. It's so worth the pain of repositioning it.
Yes. And I want to take the moment to highlight, because I hear so many naysayers that are so obsessed with their low interest rate. And I was a very cash flow driven person, so I was obsessed with that low interest rate. But when you really calculate the time and the effort that you're putting into these, in addition to the loss of the performance of the rest of your portfolio, absolutely, I have to say my medical term, stop the hemorrhage and then rebalance, and the profits and everything will rebalance and return is the goal.
And so for those who don't know who you are, Stacey, what is your background in the medical industry?
I was previously a nurse. I can't help myself sometimes.
No, it's stop the hemorrhaging for sure.
Yes.
Okay, so you brought up the interest rate situation, and it's so true. It's like, oh, how do you get out of these low rates? I can't bring myself to do it. I have sold those properties that just have cost us too much. It's the return on what did you say, Leah? The return on hassle.
Yeah.
Yeah, it was just not worth it. Yeah. And there was one where it was no hassle at all. It was just old, and so it scared me that the hassles were coming, and I knew that the issues were building, and I was like, I just want out, and we sold it. And I sometimes would question, like, why did I do that? The cash flow was really good, but I do sleep better at night, and we put it into an easier, low maintenance property. But talking about, let's say you've got a low interest rate on a property that has grown a lot in value. And that's probably lots of people, right? If you bought Leah, I'll ask you bought in Florida when prices were a lot lower than they are today. And you probably locked in really low interest rates. Would you sell those and in exchange or portfolio rebalance those?
Yeah. I mean, this is totally, I think I was on your show about a year ago now when I did that exact thing in Florida. Well-timed acquisition, not by luck, I didn't know that it would be as well-timed as it was, had a ton of equity there, had a super low interest rate. The cash flow was way juicier than I anticipated. And we actually feel good about the long-term trajectory of that market still. And even though it's popped quite a bit, we still feel like, hey, we want to hold this through the next market cycle. So we actually did a cash out refinance. And I'm telling you, people thought I was nuts to have refied I think we had like close to a 3.5% interest rate on this property. And I refied it into a DSCR at 7%. But I pulled out $100,000 and went and bought in a market where I would not have been able to get the desirable property that I got. And I actually turned it into a short-term rental, and that property cash flows, on average, $2,500 a month for me. And so, yes, I'm paying more interest to the bank for allowing me to make that like pivot, but long-term, I now own 2 great assets in great markets that I feel good about long-term. And my net cash flow is actually higher than it was with that lower interest rate. So been there, gotten the weird looks for doing it. I think you shouldn't be scared.
I might have been one of the people giving you the look.
Maybe. It worked.
At the end of the day, it's all about numbers, right? And it's so easy to get fixated on a 3% rate without looking at the real number that matters, which is cash flow and potential appreciation. So Stacey, again, like what would have you do that?
Yeah. So mine is more of that maintenance issue. So because of that, I'm more looking at that 1031 so that I can completely sell and be done with the property. But then again, still allowing me to leverage that equity by repositioning it in other places. And then as Leah already touched on, when you're able to buy multiple properties, I can replace that cash flow that I had with that low interest rate by getting multiple properties, even with that higher interest rate. And then without the loss of that cash flow, spending it towards maintenance. So it's a win-win for sure by rebalancing.
Well, a lot of people are saying you just can't get cash flow today.
I think
we have deals that say otherwise.
All right, tell us about that.
Well,
what are you finding? What are you seeing?
To use Stacey's example, we have some teams that are offering new construction multifamily properties with incredible interest rate buy downs. We've talked about this so many times. I'm a broken record. I feel like every time I'm on your show, I mention this.
Well, I'm sure there's a new listener today who's never heard it before.
Well,
it's worth mentioning again.
Yeah, and that too.
Let me blow your mind then. Okay. A builder that we work with is offering new construction duplexes and quadplexes with 3.75% conventional financing.
It's incredible. And they're eating the cost of that.
Right. And it's real. I just closed one. It's an adjustable rate mortgage. It's a 30-year amortized loan, adjustable rate 10-year. So, it's fixed for the first 10 years and then it can adjust. But it allows these deals to cash flow. They would not cash flow at today's interest rates, but when you can get an interest rate that low, not only do they cash flow, but the principal pay down efficiency with loans like that, it's the good old days. They're incredible. So you don't have to give up the low interest rate with specific product.
Yeah, amazing. I went on the property tour with that team, and I was like, oh, I want to buy one. And then by the time, I told Rich and we got around to it, they were all sold out. I was very sad. So you have to jump on these things when they come up. Stacey, you're nodding your head again. You have something to say.
I'm just so excited. I'm actually going in 2 weeks for that property tour. So I know I will get bit by that same bug.
I mean, and how long is the interest rate fixed for?
10 years.
10 years. Mm-hmm.
And most people don't hold their properties for 10 years, even though it's a buy and hold, that you're going to portfolio rebalance again, right? At some point. And even if the appreciation isn't as robust as it's been, which, who knows where that will be. There's still not enough supply out there. Even so, you've got 10 years of loan pay down. So there'll be some equity there to be able to do something else with it. Okay, well, let's talk about how you do this, because generally you want to do a 1031 exchange. Leah, how has that process been for you doing a 1031? Is it as stressful as some people think? Let's just start with what it is.
Yeah, so the 1031 exchange is a tax deferment strategy. I mean, when you sell a property where you've had a lot of gain, where you've had a lot of appreciation, it's great, but unfortunately, Uncle Sam wants his cut. And so ordinarily you would have to pay capital gain tax on your gain. But the 1031 exchange allows you to defer paying that tax. You can roll the tax consequence into another purchase, kick the can down the road, and use that capital that you had in that property to purchase the next property. I actually just did this was my very first 1031 exchange that I did, that, before I've had enough losses carrying forward that I could do the lazy 1031 exchange. And this was my first legitimate one. And I will say, on the other end of it, it was way easier than I maybe told myself it was to coordinate. Fortunately, we have great connections at RealWealth with awesome 1031 exchange facilitators, awesome lenders, awesome property teams to help you find the deals. So I think that's part of why it felt so easy for me, because I had a lot of help with our network. But it's a great way to capture some of that gain for yourself in rolling it into the next purchase. And, the plan for most people is to just 1031 exchange forever. And then the tax basis will step up for your heirs when they inherit your properties after you're no longer here. It's pretty awesome.
You've got 45 days to identify. So that's the stressful part, is a lot of times people will, put their property on the market, they'll get a buyer, and then they'll be like, "Ooh, I should probably do this 1031." And then it gets more stressful when you haven't planned ahead of time. So how do you help our Real Wealth members plan properly? Because we've seen some really get themselves in a bind, get really stressed out. They, what are some things people need to know?
I just had somebody this week that was 4 days from busting their identification period. So
Yikes.
yes.
Yeah.
And I'll just plug the new construction again. I mean, that's one of the biggest benefits, is that we have multiple markets with the construction in different phases. So we can almost align you with the perfect opportunity based on when you need that identification period to be done. So that's another benefit. But just having the wide range of markets and opportunities that we have, you're bound to find something that will align with your timeline.
That's so funny you say that. I had my radio show in San Francisco on KSFO, and I was talking about our properties our property team that we worked with in Texas. And this guy calls that day. He's like, "Tomorrow's my last day. I need to identify properties. I just heard you on the radio." I'm like, "You literally just heard me on the radio, and you're ready to buy sight unseen in Texas because you waited 44 days to make a decision." Anyway, we got him through it, and he was able to do a really successful exchange. So we don't recommend that. We would rather you have more preparation and more time, but we have been able to help people because we have teams across the country with properties ready to go. But if you don't want that kind of stress, you can speak with an investment counselor, Leah or Stacey, or like I said, Joe, and we can give the team some notice. like, hey, this is the date. We need to have these properties set aside. We've had teams that have gone way out of their way. Even I think in Ohio, our team there sold some of her own properties to make it work for someone, right?
Yeah. Yeah. We have some really good relationships that we can leverage. Stacey, Joe, and I keep a loose eye on all the inventory with our teams. And so if you are in a stressful situation and needing to find something quick, like we can get you a lot of options and make introductions that you don't have to identify junk. But ideally, you come to us with some forward planning, and we can kind of help you start kind of honing in on the specific market that you're interested in. Like the 1031 exchange that I just did, it was a new construction duplex that I went into. I actually contracted that property last August before my tenant on my relinquished property had even moved out. So it was this kind of forward thought of, okay, like this tenant's going to move out. We're going to sell it. This new construction duplex construction is going to start right before we've even got the property empty. And so we lined it all up so that I could get exactly what I wanted. And so we listed the property. Our relinquished property was in Ohio. We listed that one at the new year in January. We had it under contract and sold by mid-February. And then it was just last week that I closed on that new construction duplex. And so it was just with a lot of that advanced planning that is able to line it up just perfect. And we help investors do that all the time.
All the time. Yeah. So Stacey, you were able to help this person?
We'll see. I'm not actually sure which one he was really wanting commercial assets, something very different. So I'm not sure what he ended up going with.
Yeah. I've just seen that so often. But like I said, this is really how Real Wealth started. Back in 2006, there was another woman, I wrote about it in my book, Retire Rich with Rentals. She had 3 awful properties in Stockton, California, just old and dilapidated and high crime areas. She was just at her wit's end. Like, I hate real estate. I hate everything about it. I bought these 3 properties thinking this would be my retirement plan. I'm ready to retire and I'm nowhere close because I'm feeding these properties. Sometimes the tenants just decide not to pay rent for months. Nothing I could do. It's California. She was just at her wit's end. And for some reason, also, she called me after hearing me on the radio and was like, why do you like real estate so much? It's the worst asset class. Like, well, you got to choose the right property. It can't just be real estate per se. We helped her sell those at the peak for $400,000 each. We 1031 exchanged her into 9 properties in Texas. She quintupled her cash flow within months. Like, it was just so quick that she was able to start earning income because she bought new homes that didn't need a lot of work, that were easy to lease. People loved them, good tenants, good neighborhoods. And then the housing crash happened in 2008 and she did not feel a thing. Her property she sold in Stockton went from $400,000 to $100,000 in a year. And the properties that she had exchanged into, because she got rid of those in time, they just went up in value over time. So she would have lost everything had she not done that 1031. And instead, she was able to give that letter to her boss and say, I'm done. I'm finally retiring because of that one 1031 exchange, that one portfolio rebalancing. So it's near and dear to my heart. We've helped so many people change their lives and live what we define as real wealth, living life on your terms with the people that you want to spend your time with. That's what real estate can do for you when you do it right. All right. Any last stories, thoughts, tips for our audience?
I'm going to speak to like a common mistake that I encounter with people, with regard to rebalancing and making changes in your portfolio. And that is emotional decision making. Some people will hear this episode and hear our conversation and think about this return on hassle property, and they're thinking of the most recent, headache, and it's maybe their first time owning a rental, and so they're very quick to go, okay, I got to get rid of this property. There's just been all this maintenance. So while I do think it's important to kind of track and monitor the performance, I think it's important to give your property some time to stabilize. Stacey's owned her properties for multiple years now. So she's seeing a pattern of behavior where she can confidently say, okay, this is an underperformer. It's not just a rough year. And so, I would just tell people, come into this concept of portfolio rebalancing with a clear head. right? Nothing should be rash about this decision making. Nothing should be impulsive. You want this to be a decision that is thoughtfully considered, and it rarely is worth making these buy-sell decisions really quickly just because you run into some headaches.
Love that. And Stacey, final thoughts.
Yeah. I'll just echo, I would love for people to release the attachment to our interest rates. It was a beautiful time when we had that low interest rate climate, but we are not there anymore, and the numbers still work. So if you can get into a property that's making you better cash flow, better returns, better return on equity, and with far less of a headache, that's where the joy of real estate comes in, is the less of the headache. So definitely consider it regardless of your interest rate. I see so many people get stuck on that, and I want to encourage everybody that there is another way. We can show you how.
Yeah, when you can see the numbers on paper or on the computer screen, the difference, that's what's so life-changing. And I know you both will help investors with that process of seeing it in front of your eyes. Like, this is what you can do. This is how your life can change. All right, Leah and Stacey, thank you so much for joining me here on the RealWealth Show again. And thank you for serving our members so well. I mean, I know you're both so committed to the success of our members in obtaining real wealth as we define it. And thank you for joining me here on the RealWealth Show. If you're ready to invest in new property and rebalance your portfolio, you can book a strategy session with one of our investment counselors. It's free, so why wouldn't you? Visit realwealth.com/schedule. That's realwealth.com/schedule to learn more. I'm Kathy Fettke. Thanks for joining me here on the RealWealth Show. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.